High-frequency traders are the root cause of the recent news of Berkshire Hathaway dropping to nearly 15 cents from its original high prices. Hey everyone, Tactical Timmy here. I wanted to talk about high-frequency trading today and specifically talk about a book, Flash Boys, written by Michael Lewis, and how it applies to us today as gold and silver investors and as investors in general. So first of all, what is high-frequency trading? High-frequency trading, which is discussed in this book, Flash Boys, is a concept where by the name, it's high frequency trading. So trading very, very frequently and very, very quickly. So what does that actually look like? High frequency traders go out on the market and they are looking to actually see a customer's order. And what they're going to go do is they're going to go to another stock exchange and they're actually going to buy that customer's order and then try and go sell it to the actual customer at a slightly higher price. They're able to make these, we're talking like pennies amounts of difference between the two different stock exchanges, but they're actually able to make their money on that because they're going to be doing that for every single stock market purchase for all the different average investors out there. Now, this is going to be very, very different from how me and you as the average investor should be investing. And this is part of the thing when I was reading the Flash Boys book, is how different it is between what high frequency traders do and what we should be doing as average investors, especially as gold and silver investors. And let's make a few of those comparisons. So high frequency traders are by definition trading very, very fast and very, very often. And especially when it comes to silver and gold investing and physical silver and gold investing, we're not going to be trading very frequently. The premiums on these guys for silver, it can be north of 30%. So if you're trading this very, very frequently, you're going to be losing money. So we have to be thinking about the long run and not trading so frequently. Another thing that I noticed is that at the first sign of any trouble, high-frequency traders are going to dump it. In fact, they'll be watching the futures markets for different stocks, and they'll be looking and seeing at the first sign of trouble, they want to get out of the market, and they don't want to be a part of the actual market and be exposed to any of that market risk. They want to be in and out. Whereas us as gold and silver investors, we need to be able to accept that risk and think about our investments in terms of the long-term performance, holding over years. Just like we talked about in the first point, where we can't be trading this in and out very frequently because of the premiums, we also have to be thinking about that in terms of the long-term investment consequences. High-frequency traders, by nature, it has to do with the fast speed, and they're constantly using different tech, improving their fiber optic cables to send their signals from different places in a quicker manner. They're going to be having the fastest CPUs and computers. They're going to be having different applications, and they're going to have algorithms to take advantage of these different changes in markets. Whereas us, as gold and silver investors, or even as average investors in the stock market, we're simply not going to be having access to all this technology and all of these resources trying to get that few extra cents and get that little bit of an extra edge to make money on each trade. We have to make sure we're looking at the longer term implications of our investments and not trying to have a get rich quick. Silver and gold and the average stock market investor, it's not a get rich quick. It's a get rich very slowly. It takes time for our investments to pay off. So we talked about at the beginning of this video how recently Berkshire Hathaway had actually dropped really, really quickly. And the stock market price of that had fallen to, it was 15 cents. And it was only for a minute or so that it actually fell to that price. But what's actually causing this, and the Flash Boys book actually talks about this, is that the high-frequency trading is actually probably what's causing these wild fluctuations. And even though SEC might call it like a glitch where it temporarily had fallen and then come back up, that's actually not going to be the case of what's happening. It's probably caused by these high-frequency traders. With the high-frequency traders, they are paid on that volatility. We talked about how they make their money off of those little tiny cent differences that they can go and fill the order from another exchange and actually make the difference of that. And when they do that thousands and thousands of times, they're going to end up making plenty of money, especially on the really large order sizes. Not just like me and you going out to buy our $100 worth of stock every month, but they're going to be doing that for different pension funds that are going and buying millions of dollars of stock every month. So we see that the high frequency traders are paid based on this volatility of the stocks bouncing up and down, and they get to take advantage of that by paying different prices, by racing ahead and getting essentially it's a advantage of speed that they have, and they're able to take advantage of that information advantage and go out and buy in the market to fulfill the customer's order. So they're taking advantage of this speed, and this volatility is causing these crashes currently. And there was a famous flash crash back in 2010 that Michael Lewis talks about in the Flash Boys book. And these things are caused by that high frequency trading, and we shouldn't be surprised when we see all of this volatility and the prices bouncing around and doing these crazy things. But we do need to think about what we can do as the average investor, because Michael Lewis points out in this book that I don't think it's going anywhere. At the very end of his book, he talks about how they've recently improved from using fiber optic cables to they had been changing over and using microwaves to actually send their information. I'm talking ham radio. They're actually beaming their information from one mountaintop to the next mountaintop in order to actually make it go faster than it would travel through fiber optic cables. And they're constantly going to be trying for this technological advantage and trying to be improving forever. But that's not going to go away. They're still going to be trying to make money in the market. But we can do a few things to actually protect ourselves as the average investor. The main thing is that we should be focusing on the long run. We shouldn't be focusing on trying to make a buck when this coin first comes out in 2011. No, we should be trying to look at this coin and see that it is actually going to be making money in the long run as we keep it invested in this. The same thing goes for our stock purchases. Don't think about your stock purchases in terms of, hey, I'm going to quickly buy NVIDIA at its current price and I'm going to sell it and once it's gained $50 and I'm going to make a huge profit. No, you should be thinking about your investments in the long term and in terms of what's going to be making you money 5-10 years down the road, because that's really what you need to be focused on. Along with that, the frequency of our investment is really, really important. We aren't going to be able to get in and get out of the market like we just talked about as frequently as these high frequency traders. So what we need to do is not trade as frequency. When it comes to stocks, a lot of places will actually charge you commissions, and that behooves you not to constantly be buying and selling stocks all the time. So that's one, kind of disincentive from you having to make lots and lots of trades. But even in our modern era where we're not paying as much in brokerage fees, well, you still shouldn't be trading as frequently because those little fees that they do still have will add up. And you're never going to be making as much as these high frequency traders, and you should be focused on the long-term investing implications. I think that the final thing that I would strongly encourage you, and you're not going to be shocked if you've been around here on the Tactical Timmy channel, is to make sure that you have lots of diversification within your portfolio. You see before you see gold and silver. I also am a big proponent of having a large stock position, especially within your 401k, and making sure that you have a well-diversified set of investments. Silver, gold, stocks, real estate. If you're actually at retirement age, that's when you should consider maybe including some of your bonds. I know there's some financial advisors out there that now kind of look down upon bonds a little bit more, and that's totally fine, and I see a lot of the thought behind that. And overall, the important thing is that you're well diversified. You don't have all your eggs in one basket. You're not going out and purchasing a single stock or just silver or just gold. You want to have that diversified portfolio and following modern portfolio theory where you're taking advantage of the gains in lots and lots of different areas. It's not just gold. It's not just silver. You have to make sure you're able to take advantage of gains in stocks and gold and silver, and the only way you can do that is to make sure that you are having a diversified investment portfolio, because you're not going to be able to get in and out of these markets quick enough to compete with high frequency traders. I hope that you liked this video, and if you did enjoy it, please feel free to leave a like and comment down below. I really do enjoy hearing from each and every one of you in the comment section below. I also encourage you to go check out Michael Lewis's book, Flash Boys, because I really enjoyed reading it. It's a thriller style book, and I think that each and every one of you in the gold and silver community would benefit from learning more about high frequency trading. Take care.